So today I want to talk about something really interesting. Conventionally, it was called shadow banking or backdoor of corporate finance, but today it is becoming the main theater slowly, and that is private credit. Yes. What is private credit? Okay, let's imagine a major investment titan, of corporate finance, who needs billions today. They totally skip the Wall Street, and they directly borrow like $5 billion from private lenders. That would be considered private credit. Imagine, and the person we are talking about here is Carl Icahn, who's very famous in the US, very famous. Bill Ackman versus Carl Icahn, but I'll digress. And imagine like a software company that needs $5 billion in direct loan. They entirely bypass the public markets and public debt markets, and then they just go and borrow from private credits. And this happened like recently in early 2025. A global software company called SoFi raised like $5 billion, but they raised it in hybrid structure. So 50% of it is a loan and 50% is like equity. So 50% would be paid back and 50% equity would be transferred. So 50% of that amount's equity would be transferred. So this highly flexible borrowing, which is done in private setting, where the terms are not set by regulators, like unlike in a conventional bank, where the regulators are the one who will explicitly mention, like what would be the terms and conditions. In private markets, it's the fund manager or the person who's running the fund can negotiate with the borrowing party directly, in such a hybrid structure. Like this company that borrowed, like one of the biggest hybrid structured borrowing, $5 billion. Half of it was equity, half of it was debt. Let's go into this idea of what is private credit and how did it became a thing. So non-banking lending, it's bespoke, it's bilateral. It's a debt which is negotiated by two parties directly, between a fund and a corporate CFO. Not traded, not standardized. So what happened is, post 2008 financial crisis, Dodd-Frank Act passed, and because of so much mess these big banks had created, that they were supposed to be tightly regulated. So instead of giving more loans and stuff like that, they became very, very conservative in a lot of ways, especially across the world, even in India. So let's first talk about this whole thing. So they became very conservative. They started running what we call fortress balance sheet, which is essentially they abandoned the middle market. They abandoned the market which was between the corporates. You can lend to corporates directly. They abandoned that market because that was considered relatively risky, and they shifted towards safety after 2008. So what happened? So I'll just give you a rough projection of what the market is looking like. Private credit market is looking like in the US. So around 2008, pre-2008, it was less than $500 billion. It was a rounding error. In 2015, $500 billion. In 2020, $1 trillion. At 2024, $1.7 trillion. And in 2008, it is projected to be about $3 trillion. So what are the four big demands on which this whole private credit industry is sort of structured? And they are diversification, yield enhancement, flexibility, and it's symbiosis with private equity. and I'll explain one by one. So diversification basically means that when a private credit fund gives money to a company, conventionally, it goes to either equity or treasury. If they are playing it safe, it can go to treasury. If they are playing relatively risky, it can go to equities. But to find a very good middle ground where like there's not a lot of commodity shock, and private credit is, of course, it locks up the money. That's a little downside of private credit. But if you hold it to the maturity and based on the terms you negotiate, it is actually a great way to diversify your portfolio. Second is yield enhancement. Of course, when you are investing in treasuries or when you are investing in equities, equities come with probably better upside, but then it's significantly volatile, and treasuries are again very stable, but they don't give that sort of juice to the yield. So to perform your overall fund better, it can be a pretty good structurally good bet to give funds or lend money to a good company via private market. And of course they will pay a premium, because again they can access the money much quickly than what a conventional bank would, because it take a lot of time. Third is flexibility. So things like payment in kind, where payments can be structured in a lot of different ways, where it could be paid in equity, it could be paid in like payment in kind, specifically when the first year would they're not supposed to pay the interest via cash. It will be added on the back of the existing principal. So you can it's between the CFO of the company and the fund. There is not a lot of need of they are I'm not saying there's no need, but there's the structure could be self-defined, let's put it this way. And the fourth is symbiosis with the private credit. Basically a lot of symbiosis with private equity. So when it comes to private equity, a lot of private equity funds like to borrow money, and when they have to close deal in a very relatively short period of time, they would want funds to be accessible relatively on a shorter notice. On the other hand, banks will take months, and when it comes to a buyout, or when it comes to deal, a private credit funds can get it delivered in in few weeks. So that's a big flexibility difference. Now when it comes to private credit, the American private credit is now actually showing the sign of weakness, and it's in the life cycle where it's in the declining phase. But when it comes to like overall like where the money is, North America commands like 60% of the market. So when it comes to private credit, the entire private credit, it's solely focused on United States right now. Asia Pacific commands like 46% of GDP, but it only commands 6 to 7% of private credit asset under management, which brings me to the fact that India is one of the fastest growing markets for private credit. It has grown 10x in past 1 decade, and conventionally the private credit in India used to be this sick, the medicine you will have to take when you are sick. It's a bitter medicine. You have to pay a lot of money in interest. It's a high interest, high risk sort of things, a thing for the company, and it used to be the same for the creditors. But after the recent changes the government of India has done in insolvency and bankruptcy code, it has become substantially easy for a lender to recover money. That actually helps a lot of good companies to borrow capital at a much efficient price and like lower interest rates. So I'll come to India now. So India is like the fastest G20 growing economy. So it's growing at 7% approximate. And in 2024, 1 lakh crore, that is $130 billion, was raised in equity plus debt markets. Crossed $1 trillion in FDI inflows since 2000. Okay, but there is a simple, credit vacuum which exists, because what happened is Indian banks recently had a lot of NPAs, that is non-performing assets. Indian banks were just sick of having these crazy non-performing assets, and recently they cleaned up their act, and it's only recently now things are looking, when it comes to balance sheet, Indian bank balance sheets are looking decent. But over 2010s, Indian banking sector gave out a lot of bad loans. Some of it was macro headwinds, including the global financial crisis, and then there was a commodity shock that came after China started dumping a lot of steel and a lot of these things, and there were political issues alongside it, where it was said that a lot of lending was done under political influence. So because of all these factors, Indian banks gave out bad loans, which led to a situation where Indian banks were filled with NPA, not performing assets, NPAs, and once they had to clean up their act, they became super conservative, and they stopped a lot like US banks after 2008. Indian banks stopped lending to a lot of corporates, and this created a fundamental demand supply constraint, where Indian corporates and Indian GDP, which is growing at like record breaking pace, a lot of these companies were not able to borrow capital at efficient and in a very well structured way. So here's where the private credit actually stepped in. Now, because of this NPA trauma banks suffered, private credit industry actually came in to fill the void. So let me give you a very interesting real world deal mechanics here. So for example, if a steel company in India borrows 3,200 crores, that is about $380 million across 3 funds, okay, they are paying an interest rate of 14.5% compounded monthly plus 3% kicker. So it's an upside for equities. Like if it works out, they get 3% in equity as well. So it's an effective interest rate of 17.5%. Now, a conventional bank will not usually allow these sort of trades, because conventional banks will not take equity or structure the loan in such a flexible and in-kind format. And so I'll give you another example. If a sports industry, like sports firm industry, basically borrows 1,000 crores at flat interest rate of 16%. Now, why would companies be willing to pay these sort of high interest rates? Well, usually the state of the market is such a way that when these private credit firms get involved, it's not like fixed capital, which is like, it's not working capital for the businesses. It's usually what you call bridge capital or transition capital, because in some cases, if these capital, these borrowing of capital is sort of last resort, and if companies don't do that, they usually are in a situation where their assets will be seized, and then the companies will go out of business. So usually it's structured in such a way that it's very high interest, but it's risk capital, it's arbitrage usually in that format. Now let's talk about ICB, that is Insolvency and Bankruptcy Code changes that happened in 2016, which actually led a lot of Indian private credit funds to be first in line when it comes to if a firm goes bankrupt. Before 2016, the issue was the bankruptcy took more than 4 years. You have to take the bankrupt party to court, and there are so many legal proceedings. Defaulting person would still have control of the asset usually, and then you have to go to court to not let them continue to have the access to the assets. So for example, if a private credit fund gives capital to an Indian company, and that company goes bankrupt, so the lenders can't immediately seize the entire property till the time bankruptcy goes through. The property will be able to accessed by the bankrupt party, and that will lead to the usage of the non good usage of the property, but and then in 2016, after the changes, now as soon as a bankruptcy gets declared, promoter is immediately stripped of the assets and of the control of the asset on CIRP's admission. There is this 330 days resolution mandate now. So first it was 4 years they used to take, now it's just 330 days, and as of 2024, 1068 CIRPs resolved, unlocking 3.55 lakh crore for creditors. And now the creditors have something called as super priority, in which the money they have lent they have lent to these financial these companies, these corporates. In case of bankruptcy, these creditors have what you call super priority. So new capital injected during the bankruptcy jumps to the first in the line when it comes to repayment. Now where the money flows, essentially, well, the money flows towards, there are few big sectors: real estate, power and utility, infrastructure, and pharma. And this is specifically we are talking about Indian scene. 24% of the money flows to real estate markets in India, and then 20% to power and utility, 15% to infra, and 5% to pharma and healthcare. Usually these funds are used for refinancing, acquisition, and growth capital. Initially they are being used for the growth capital, but conventionally the big chunk of it is refinancing and acquisition. Now the risks of this whole private credit situation. Well, first is yield compression. Since too many, you know, too much money is chasing the very few high quality deals, the interest rate goes down. The borrowing for the corporates become relatively cheaper, so yield compression happens. Then is covenant lined light lending. So basically funds chase the return by relaxing protections again, since they have to effectively chase the same number of limited high quality deals. They have to compromise on their returns. And then there is complex leverage, multi tranche deals, PIK toggles, and there is extreme complexity that happens when complex leverage is involved. There are so many, because again in private credit, the terms are not structured in a similar way, so there could be multiple parties with everybody having their own set of complexity when it comes to private credit. Like everybody will have their own terms and condition. So recently RBI has started sort of having a little having a little more regulation on the private credit industry, as Indian regulators are very very first in line when it comes to uh, you know protecting the institutions, and making sure that there is no systematic this risks involved. Last is the big picture. The big picture is this: India's credit to GDP ratio, so private credit to GDP ratio, is 0.6. That is very small, and signals like there is further like a lot of ground to grow. US ratio is 3.8% of the GDP, while India stands at 0.6%. If India reaches at least even like the half of what the US level is, it still means there is going to be an extraordinary space. It's a blue ocean opportunity. So Indian private credit market is is about to grow, and grow pretty rapidly. In short, if these alternative asset managers amass trillions in flexible, aggressive capital, do Wall Street bankers and the commercial lenders become mere deposit, utilities handling checking accounts and mortgages, while private credit funds do actually business of underwriting real companies? When the next corporate titan needs $5 billion, will these traditional banks even get a call or a courtesy call from them, or will they directly bypass the entire conventional system and just go and get money from private credit? I think it's a question which is increasingly being answered as yes, and all of the big tech companies, that includes OpenAI, and a lot of this AI build up now is also financed by private credit, and Blue Owl is one of the big famous firms which is actually involved in a lot of these things. So I think increasingly, as private credit grows, especially in India, it's going to be substantially interesting in following this journey. And thanks for watching the video, and follow for more stuff like this. Have a good one.